The stock market has rallied sharply since President Donald Trump paused most reciprocal tariffs on April 9. The S&P 500 has gained nearly 20% over the period, which includes an impressive stretch of 9 consecutive up days. The technology-heavy Nasdaq composite has done even better, returning 24% since its early April lows. The stock market's reaction to Trump's tariff pause took many by surprise. Stocks had sold off sharply in the days immediately after the president announced harsher-than-expected reciprocal tariffs, fueling fears of both inflation and recession. The speed and depth of the decline set the stage perfectly, though, driving most stocks, including the major indexes, into oversold territory. Hope that cooler heads would prevail and more manageable tariffs would emerge, thanks to negotiations, proved the perfect catalyst for gains. Yet most of the reasons for the stock market's decline remain. Now that the market has recouped the bulk of its losses since mid-February, further gains may be harder to come by, especially given one uncommon signal that recently flashed a warning. A decisive bull market drove the S&P 500 to back-to-back 20%+ returns in 2023 and 2024, including an impressive 24% gain last year. Those gains were built largely on optimism that the Federal Reserve would pivot from hawkish to dovish monetary policy as it shifted focus from battling inflation to supporting employment. Investors were also encouraged by a tsunami of proposed spending on artificial intelligence. Companies flocked to develop AI chatbots and agentic AI apps following the hugely successful launch of OpenAI's ChatGPT in November 2022. Unfortunately, those bullish tailwinds faded this year. The Fed cut interest rates in September, November, and December, but it has since paused additional interest rate cuts over worry that progress against inflation had stalled and that inflation could resurge because of the president's tariffs. In April, the Consumer Price Index showed inflation at 2.3% in line with 2.4% last September, but still above the Fed's 2% target. A sidelined Fed has removed some enthusiasm that lower rates would increase business investment and lower interest expenses on variable debt this year. This in turn has hindered corporate sales and earnings growth, which historically drive stock prices higher. AI spending growth could be near its peak. In January, the arrival of the Chinese-built DeepSeek R1, a rival to OpenAI's ChatGPT and Google's Gemini, surprised everyone. That's because it had been developed for only $6 million using cheaper legacy semiconductor chips, rather than NVIDIA's newest, fastest graphic processing units. To be sure, AI spending is expected to climb this year, but the pace of the growth is projected to slow, and macroeconomic worries could lead the biggest spenders, including hyperscalers Amazon and Google, to rethink their data center plans. The Fed's about-face, AI spending worries, and Trump's so-called Liberation Day tariffs announcement from April 3rd helped wipe much of the excess out of the stock market. However, now that stocks have recovered losses, they're arguably pricey again. The benchmark index is now trading at a forward price-to-earnings multiple of 21.4 above the 5-year average of 19.9 and the 10-year average of 18.3. In April, it had gotten to 19.4. Historically, the market's 1-year returns are negative when the forward S&P 500 price-per-earnings multiple is between 20 and 22. At April's lows, most sentiment measures were heavily oversold. For example, CNN's Fear-Greed Index registered extreme fear, while an American Association of Individual Investors survey saw bearish outlooks for the coming 6 months surge to 61.9%, the third highest on record, and the highest reading since the stock market's March 2009 lows during the Great Financial Crisis. Similarly, the Volatility Index, or VIX, had skyrocketed over 50 from near 20 before Liberation Day. And the Chicago Board Options Exchange, CBOE's put-to-call ratio, measuring bearish put option to bullish call option activity, had reached 1.2 levels of fear coincident with relief rallies. Those measures aren't nearly as bullish now. The Fear-to-Greed Index is at greed. American Association of Individual Investors' bearish responses have fallen to 44%, still high, but not nearly as high as they were in April. Meanwhile, the Volatility Index, VIX, is back to 21 and the put-to-call ratio is below 0.9. Overall, the sentiment signals that helped spark the S&P 500 and Nasdaq's rally aren't nearly as cooperative now as they were 6 weeks ago, something that's also supported by another relatively uncommon signal, a relative strength index, RSI, 14, reading near 70, RSI 14 measures price action over the preceding 14 trading periods and can signal when stocks become overbought and oversold. An RSI above 70 on the S&P 500 is a cautionary signal, while a reading below 30 suggests a rally may happen. On May 15, the Nasdaq 100 ETF, QQQ, saw its RSI eclipse 70, while the S&P 500's SPY RSI was over 69. That starkly contrasts with RSIs in the low 20s near April's low. It's also the highest RSI on the SPY since December 4 and on the QQQ since mid-December, which preceded losses through mid-January. Of course, no signal is perfect, and stocks can rise and fall more than anyone thinks. They can also remain overbought and oversold for a while. Still, the rise in the RSI readings is cautionary, suggesting the stock market could experience some backfilling of its recent gains as profit takers emerge and worries about the economy resurface. We may see that play out, given Moody's surprising downgrade of U.S. debt on May 15 and the ensuing rally in Treasury yields. The 10-year Treasury note yield hit 4.59% on May 21, up from below 4% on April 4. Meanwhile, the 30-year Treasury bond yield has increased to 5.08% from 4.39% over the same period. Higher Treasury yields can signal decreased economic confidence. Since high yields make bonds more appealing, they can be a headwind to additional stock market gains. Given that backdrop, the decline of the S&P 500 and Nasdaq composites by 1.7% and 1.4% on May the 21st of May, not be that surprising. If you found this useful, please share, like, and subscribe for more insights into today's economy and more ways to put more dollars in your pocket.